Hey traders, this is Blake Morrow with Traders Summit, and it is Friday. So today we have Jim Welsh from Macro Tides once again. Hey Jim, how are you?
I'm great. Thank God it's Friday.
Yeah, TGIF. You know, what a week to discuss, because obviously the Fed met this week. They kind of teed it up as the market was expecting. We got some volatility. I should have finished my thought. The Fed teed us up for the next Fed meeting. We kind of got what we expected.
Right.
But there's a few nuances I think that the market should be paying attention to, and I think that you wanted to talk about. So let's start with the dollar. We're hitting all-time highs in the dollar as we speak, or at least this morning, as it's Friday. Dollar index registers a new 2022 high. What are your thoughts on the dollar? And I know you brought a chart. So what are your thoughts on the dollar and what the response has been to the Fed?
Well, I think, again, the Fed laid out a plan, which I really discussed at length in my Monday, January 24th weekly technical review, that the Fed would dismiss the idea of 50 basis point cuts. At the same time, I think the Fed laid the groundwork for raising rates at successive meetings, which is something you and I have talked about for a number of weeks.
Front loading, right?
Yeah, exactly. The Fed would be well served to raise rates a quarter of a point at the March, May, June meeting, because what they want to avoid is, being behind the curve 6-9 months from now, and then having to ramp rates up more aggressively. And going from 0 to 75 basis points is the easy lift from a standpoint that it is not going to really materially impact the economy. It might have obviously implications for the financial markets, but their focus is on the economy. Also, I think Fed Powell said that, the idea of a Fed or the S&P put, I think he kind of really threw some cold water on that. They're tied to the economy and inflation. And I think that's why the equity market is struggling, is the realization that the Fed doesn't have our back anymore. In terms of the dollar, very quickly, as you know, we were talking last summer, I was looking for a low in the dollar in the June timeframe. It bottomed around 89.50. And the fundamental case was that the Fed would be removing accommodation way ahead of the ECB, which would be a tailwind for the dollar. And secondly, and almost as importantly, the dollar was completing a big ABC correction from the January 2017 high at 102.80, I believe, or 103.50, one of those two numbers. So here we've seen the dollar from the low late May, early June.
Yeah.
And again, as we talked, I kept for weeks and weeks and weeks, like, okay, the dollar's going to break under 95.51, and that's going to be wave 4. And it would come down to where I had those two horizontal lines, and it did, basically right into that zone. And then my expectation was that we would see a rally to new highs in the dollar index, getting up to 97.50 to 97.75. I believe it got to 97.44 so far. So I think we're nearing the end of wave 5. And at a minimum, it implies a pullback back to the lows we saw 2 weeks ago. And I think potentially a deeper correction, because sentiment, which was really negative last June, has become pretty positive. Positioning reflects that as well. And the logic here, Blake, is people are thinking, oh yeah, the Fed's going to be tightening policy. That has to be good for the dollar. The problem with that logic is it makes a lot of sense. However, at some point in time, people's emphasis shift from what is the central bank doing to how an economy is going to perform. So my belief here is that at some point in time, in the not too distant future, the focus is going to be that, hey, the ECB is going to stay accommodative for far longer. The Fed is actually tightening. 12, 18 months from now, the US economy is going to be slowing because of that, while the EU continues to be okay. So I think that's the hook that is going to get a lot of people who just use fundamental analysis and something very logical. Oh, the central bank raises rates, currency must go up. So I think that's the framework. Technically, I think we're nearing a high of some magnitude. We'll just have to determine that based on what kind of pullback we see and the nature of the pullback. But I think that will be bearish for the dollar and bullish for the euro. And if you look at the euro, you can see 5 waves down very clearly. I was going to send that chart too, but I didn't want to overburden, you know.
Well, you know, the thing is, I guess you look around, you know, the currency market, and you start talking about where the dollar's at. You know, the dollar yen struggling above the 115 level. You know, we've seen it, you know, for the last couple of months. We've seen the Aussie dollar that's, you know, back at the 70 cent, big 70 cent handle. It's a big level for a lot of Aussie traders. And you got the sterling that's, you know, above 135. That's really, you know, hasn't given up a lot of gains relative to what's happened to the euro for the last several months. So, you know, the euro is obviously, you know, trading below 112 right now. I guess you're in your view, then, you know, you're looking at these opportunities on the euro to be a buyer of the euro down at these levels. Do you think we're going to get below 110?
I don't think so, because when I look at like a 30 or 60 minute chart of the dollar, last week or so ago, it looks like we're nearing the end of wave 3. So you might get a little pullback and then one more little push up in the dollar index. At the same time, you know, that there's no guarantee you're going to get that last little tick higher. So the bigger picture in my mind says, take a position in the euro on the long side here, and then add to it as you see a price reversal. You know, there's probably some levels that I'm sure you're very knowledgeable or familiar with in terms of, gee, if it gets above this level, that's going to be a positive sign technically. And that's the way I trade the euro. Yeah,
it's where it starts taking some of the downside pressure off. Okay, well, let's you know, I like your view on the dollar because it's in line with what I'm thinking as a trader, but more importantly, it's you know, you've given the technical points here. Let's talk about the S&P. So how do you feel about the markets? I mean, we've seen a lot of volatility, and by the way, when I say a lot of volatility, this is you're seeing some big wild intraday swings starting from Monday, but it seems like we're more consolidating here. What are your thoughts longer term with the S&P? Are we still in sell rally modes, or are we in buy dip mode? What do you think, and how do you translate that based on what the Fed gave us this week? I mean, if there's no Fed put, do I buy stocks here, or do I sell rallies? What are your thoughts?
No, again, I'm not that bearish yet. Okay. You and I talked about this in December and in early January, that my expectation was that the S&P would have a 10 to 15% correction in the first quarter. And a couple of weeks ago in the January 17th weekly technical review, you can see that red line on the chart where the notation about breakdown. And what I basically said is, I think there's a bounce coming, but if the S&P closes below 4,600, a quick drop to 4,400 will follow. And, you know, not only did it go to 4,400, went all the way down to 4,223, as we saw on Monday. So looking at the price pattern of the S&P, you can see from the high that the blue numbers show a wave pattern. So wave 1 down ended at 45.82. You got a bounce to 47.49. I believe wave 3 ended last Monday, 42.23. And now we're in wave 4. And it may have completed at 44.50. In this past week's weekly technical review, I put out 2 numbers. I said, okay, I think the S&P can rally back to 44.50 and potentially 45.20. And so to me, there's on I think Wednesday, it rallied to 44.53. We've pulled back. I think potentially, Blake, that rally to 44.53 was wave A of 4. The pullback to the low this morning was B of 4, and that there's going to be a C wave of 4 that takes us up to near 45.20. And then I think we're going to see the S&P drop below 42.23. So my take is, I think we're going to see sooner or later the S&P drop below 42.23, and that will complete 5 down potentially and complete this whole correction. It could get a little more complicated than that, but once we finish that 5 down, we're going to get a rally back to whatever high, whether it was 44.53 or whatever high. If I'm right about a wave C of 4, it will come back to that high. So we don't have to address that at this point in time. The main thing is, if it gets over 4,500, I think that's a place to go short, and then look for that drop below 42.23. The main reason why I'm pretty negative, and I've written about this, is for years, owning technology amply rewarded people. And so it's an overweight trade for a lot of institutions. And finally, they're facing the prospects of an extended period of monetary tightening, which compresses PE ratios, especially on those companies that have high PE ratios, and that the technology stocks were going to be vulnerable to that process. And I think what we're seeing is institutions cutting their overweight position, maybe not all the way down to neutral, but they're reducing their exposure to technology. And since we're talking a whole bunch of money, and the weighting of technology in the S&P got up near 25%, this process of selling into rallies is one of the reasons why I think the market's going to struggle for a period. So again, this wave 4 could complicate, and we finish 5 down, we get another bounce, another pullback. Can't know that information quite yet. I believe the key thing here is sometime in the second quarter, we're going to see inflation numbers come down, by a fair amount. And if the Fed does listen and raise rates 3 times, March, May, and June, and inflation starts to come down, that would be the opportunity for them to hit the pause button. So that's why I'm still somewhat constructive that I believe there's a window of time where the Fed could hit the pause button. Now, there's risk to that forecast. I'm writing the February macro tides, and I'm going to discuss some of those risks in that letter. But I still think the odds favor the opportunity for the Fed to hit the pause button at some point in time in the second quarter.
All right. So, just to sum it all up, you're basically looking to sell rallies, anywhere above 4,500, looking to sell rallies, and we might take out that 4,220, and then you want to be a buyer somewhere down there, but you need more information to really figure that out moving forward, which, hey, look, we, as traders, we're just trying to get like a good theme to trade against and to trade on, and a good roadmap. And I think you're providing that for traders today. So Jim, I want a couple last minute thoughts really quick. How do you feel about precious metals? Obviously gold, succumbed to the, back below 1800, back below the 200-day moving average. You got yields rallying. What are your thoughts on yields, gold, real yields? Is it affecting gold? What's your thoughts there really quick before we wrap up?
Okay. I had recommended buying gold. I can't remember how many weeks ago. It's been a while, and got stopped onto that position with about a 1% gain this week as gold started to break down below 1815, because that to me was important. That's what I wrote about on Monday. And gold's failure to get above the downtrend line at around 1860. So it's in a huge triangle, and we're still in that apex of that triangle. So until it breaks below the lower line, and I'm guessing I haven't looked at a chart for a day or two, 1765, I'm guessing. Okay. Yeah. If you go back, you can see that trend line. We're still in the apex. So to me, gold is indecisive. If I'm right about the dollar peaking out and then beginning to decline, that potentially could be very helpful for gold, because it peaked in June of last year as the dollar was making a bottom. So I think that's the one potential plus for gold, but the price action, has really been not great.
Yeah, it hasn't been great. And I think that trend line you're referencing is around the 1775 level. So we'll see if gold can find some support down here, especially if you're right and the dollar is peak near term, and we see stocks rally, maybe risk rallies, you might get a little rally in gold. But what are your thoughts on yields here?
I still think the 10-year and the 30-year are going to see a higher yield than what we saw, I think a couple of weeks ago. Yeah. I think the 10 got up to about 187, 188. And I think that's out. And then I think we're going to see a period, ironically, where based on the price pattern and stuff, that we'll see yields actually come down for window time. As I said, we're going to get a lot of ugly data in February about the economy. So that may be supportive of treasury yields actually coming.
Yeah, and I was going to say, so how much weight are you going to put on the data between now and March, the March meeting at the Fed? Does it really matter, or is it everything that the Fed's doing set in stone? Set in stone. Okay. It's stone. Okay. I mean, 40-year highs on inflation, Blake. They're not going to blink. They understand that and to a certain extent, I mean, they have to remove some accommodation. That's, and they will. And that's why I think the equity market could be vulnerable again during the month of February, because we're going to see hawkish talk from just about every Fed member,
and negative economic news. And people, in a sense, we're at that place where we were for a long time. Good news and bad news was good news for the stock market. Now we're at a place where good news and bad news is not good for the stock market. We've reached that place psychologically, and that has to play out, and it's going to take a little while for that to play out. So volatility is going to remain over the next 2-3 months at a minimum.
All right, Jim. Well, wise words from Mr. Jim Welsh. As always, Jim, I love your work. And if you guys are watching via YouTube, make sure you give them a thumbs up saying, hey, I like seeing your stuff every week, Jim, because I know I do. And let's make sure everybody else does too. And I'll also subscribe to our channel so you don't miss any of Jim's content each and every week. But Jim, if I'm a trader trying to figure out who the hell is this Jim Welsh guy, how do I find out more about you?
Macrotides.com.
All right. Well, that's the place to be. And I do appreciate being somebody that receives your analysis and your forecast. I love the fact that you like to update, your subscribers, all the time. So especially as we have a ever-changing and evolving environment. So Jim, thanks for joining us today. Have a great Friday. And we look forward to speaking to you next Friday.
You got it, Blake. Have a great weekend.
All right, you too. Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.